I'm a guy who for the last 5 years learned non-stop to find out what are the best ways to invest money to increase your wealth over time as fast and as risk-free as possible. In this video, you will learn my perspective and secrets how investing in REITs is better than real estate, how it can become one of the easiest and very lucrative passive income sources of yours, and how it can even change your life. Quick spoiler, you can do it way faster and way cheaper than you might expect. So, what is REIT and why you should even consider using this investment vehicle? Real estate has been one of the best performing asset classes in history. REITs, which stands for Real Estate Investment Trusts, are the type of fund which invests mostly in income-producing real estate assets. Income made from REIT flows directly to unit holders or the people who invested in certain REIT fund. Investors who own this fund also participates in capital appreciation of the buildings. Taking into consideration all the information we went through, we can easily say that investing in REIT gives you ability to own a liquid, diversified portfolio of real estate assets without the headache of managing real estate on your own. Biggest turnoff for investors who would like to invest directly into real estate might be liquidity, big starting capital needed, management intensiveness, and lack of ability to properly diversify your portfolio. All of these turnoffs goes away with REIT investments. Similar as with stocks, you can buy low-cost index funds of REITs as well. In this video, you will learn how this investment vehicle can fit into your portfolio and grow your wealth almost passively. One of the most important things to understand while thinking about REIT index fund investing that any total market equity ETF will already have a certain percentage of investments allocated to real estate. US and international stock markets have about 5% of your total assets in real estate. This might be very important to understand before even thinking of adding REIT ETF to your portfolio of index funds. You must understand that very common mistake is to overweight REITs in an existing portfolio. This basically means adding too much of this investment vehicle to your portfolio, viewing this as a distinct asset class. The one who is interested in investing into REIT first must understand that for the best diversification he must first know if this current ETF portfolio is not heavily allocated to real estate already. If in your current portfolio REIT ETF would be distinct asset class, adding this investment vehicle to your stocks and bonds portfolio will result in diversification benefit. If majority of your portfolio consists of stocks and bonds, it will be quite easy to back up this diversification benefit since REITs have literally no correlation with stocks and bonds. Also, returns of REITs are not well explained by market alone. One of the biggest advantages of why investors consider adding REITs to their portfolio that this investment vehicle's returns have been great compared to other asset classes. In the last 30 years, S&P Global REIT Index returned for about 9.2% per year on average. To compare, MSCI All Country World Index returned for about 7.7% per year on average. Those two indexes together combined in a portfolio might seem like a really strong move. Let's discuss if this is correct. If REITs are really distinct investment vehicle, we should not accept the no-risk factors that explain stock and bond returns to be able to explain REIT returns. Study in 2018 by Peter Mladina studied how distinct the returns of REITs are from bonds and stocks, especially from the risk factors perspective. Mladina used 5-factor model to find out how well the return and risk of REITs and direct real estate are explained. The factors he examined are market beta, size, and value. Those are all equity factors to consider. The study covered 30 years of time and the results were surprisingly unexpected. The factor exposure of real estate roughly resembles that of a portfolio consisting of 40% high-yield bonds and 60% of small-value stocks. Taking this into consideration, we can state with confidence that REITs might not going to give us something new that we could not already get from stocks and bonds, making it not so distinct investment vehicle from the others. Quote from one of the most important findings of this Peter Mladina study says that, while stock and bond factors explain the returns of real estate, the risk of real estate is primarily driven by the idiosyncratic risk of the real estate sector. This point is very important to understand, since it will clearly let you know if REITs might fit into your portfolio. Peter Mladina found that the factors that explain the returns of real estate are priced risks, which are risks with a positive expected return. While returns of the REITs might be explained by the priced risk factors, risk of real estate, however, primarily driven by idiosyncratic risk of the real estate sector, which is not the priced risk. Let's quickly summarize this section. The returns of real estate, including REITs, can be explained by exposure to risk factors that we can already get from stocks and bonds. However, REITs add one distinct risk: idiosyncratic risk, which is exclusive for the real estate sector. After we made a clear point that only investors who are not overweighted their portfolio with broad index funds with real estate allocations should consider REITs, now we can discuss why REITs are better than direct real estate investing. With direct real estate investment, you buy a specific property or a stake in one. Direct real estate investing lets investors make money through rental income, property appreciation, and profits generated from any business activities depending on the real estate. Let's go through a few pros and cons of direct real estate investing. One benefit of investing in physical properties is the potential to generate substantial cash flow, as well as the ability to take advantage of numerous tax breaks to offset that income. For example, you can deduct the ordinary costs to manage and maintain the property. Another tax break is for depreciation. You can deduct the costs of buying and improving a property over its useful life. This will lower your taxable income in the process. Another perk of direct real estate investing is that you have more control over decision making that you would with REITs. For example, you can select only properties that match your preferences for location, property type, and financing structure. In your control of things like rental prices, choosing tenants, and deciding how many properties to buy. You can also refinance mortgage at any time when interest rates drop for better conditions. Now, in my eyes, biggest disadvantages of owning and investing into direct real estate are that it requires a lot of time and energy, as well as risk of financing default. Also, this type of investment vehicle is not liquid at all, meaning not easy to buy and sell. This is making you slower in investment game and possibly lose you opportunities which require to act fast. Now, talking about REITs, perhaps the biggest advantage is that individual investors can access profits from a real estate without a need to own, operate, or directly finance the properties. Also, it is really low cost way to invest in the real estate, since you can invest in a REIT fund with as little as $500, which makes a way lower entry point than direct real estate investing. Another benefit is that REITs offer enticing total return potential. This is because by law, REITs have to pay at least 90% of taxable income to shareholders, and it's not uncommon to have 5% dividend yield. REITs also have the potential for capital appreciation as the value of the underlying assets increases. And last but not least, one of the best perks of owning REIT funds is liquidity. Like stocks, you can buy and sell REITs faster than you change stocks. This is because REITs are traded under heavy volume, which means you can get in or out of a position in a market basically whenever you want. Few drawbacks of owning REITs versus direct real estate is that you have no tax advantages. Also, REIT investments are more sensitive to interest rate fluctuations. Last risk worth mentioning is that while you invested in REITs, you might be involved into property-specific risks. While REITs overall can help you diversify your portfolio, most individual REITs aren't diversified at all. That's because we focus on a specific property type, such as offices or shopping centers. For example, if a REIT invests only in hotels, if economy goes down and people stop traveling, you will definitely be exposed to those type of risks. However, taking everything into consideration, for a new investor it is definitely way easier to delve into REIT investing than in a direct real estate investing. It's Gentleman's Finance channel. Here we'll learn about different business opportunities, how to make money and invest wisely. Here you will also learn how to increase your wealth and become debt-free. All men should take care of their own finance. If you are interested in accumulating wealth and improving your financial future, make sure to subscribe this channel and hit a like button. Also, comment down below I subscribed and I will try to answer all of your comments. Now let's go back to the video. At this point in the video you might say, but Gent, you hooked us in the start with the idea that REIT investments can become great source of passive income as well and you still did not cover it. We feel clickbaited. No worries, here's this section where we are going to discuss how it can become quite easy and low maintenance passive income stream. Well, there are many ways to make passive income from real estate and they range from a low cost, truly passive investments to more hands-on methods of generating income from real estate investments. Let's take a look how REITs investments can really provide even new investor with a passive income. First of all, REITs are traded publicly on stock market exchanges, so this investment vehicle is one of the easiest and lowest cost way to invest in real estate to collect passive income. This is because REITs must distribute 90% of their taxable net income to shareholders via dividends to maintain their tax advantage status with the IRS. That's one of the reasons why it makes REITs perfect passive income source. Talking about low cost, owning most REITs can take maximum $100 each and you only need to buy one share to get involved. Public REITs are also highly liquid because you can buy and sell shares through brokerage account any day the stock market is open. To conclude, I would like to summarize everything and make it easier for you to decide if REIT investment vehicle is advantageous to have in your portfolio. Biggest advantage of owning REIT ETF versus a direct real estate is liquidity, low cost to entry and no need to actively manage a real property, thus making it more passive. Taking into consideration all these pros, this investment vehicle can really start generating your passive income instantly, even if you are a new investor. Thanks for watching. If you found any value, please like and subscribe. It really helps a lot to keep going with useful content for you guys. If you are interested in learning more ways you can make passive income instantly, I would recommend you watch a video I recently made, which will be included in the end of the video and in pinned comments.